Hi, welcome to Investment Analysis and Portfolio Management course. The title of this module is Asset Pricing Models, Capital Asset Pricing Model, Arbitrage Pricing Theory, and Factor Pricing Models. The section goal is to understand the portfolio theory and asset pricing models. The module goal is to understand types of asset pricing models, including market, single, and multi-factors. Let's first discuss about the concept of capital asset pricing model. CAPM is building on the work of Markowitz. It is a set of predictions concerning equilibrium expected returns on risky assets. By definition, the CAPM is a model that describes the relationship between the expected return and risk of investing in a security. It shows that the expected return on a security is equal to the risk-free return plus a risk premium, which is based on the beta of that security. The core ideas of CAPM are investors have identical beliefs, investors optimize using the Markowitz, and nobody do not have enough wealth to move the market. CAPM use beta to relate an asset's risk relative to the market to the asset's expected return. The formula of CAPM is used for calculating the expected returns of an asset. It is based on the idea of systematic risk or non-diversifiable risk that investors need to be compensated for in the form of a risk premium. A risk premium is a rate of return greater than the risk-free rate. When investing, investors desire a higher risk premium when taking on more risky investments. So, the formula for CAPM is expected return is risk-free rate plus the multiple of beta with risk premium. The beta is a measure of a stock risk or volatility of returns reflected by measuring the fluctuation of its price changes relative to the overall market. So in this concept, all investors will hold the same portfolio for risky assets, which is market portfolio. It contains all securities in the market. Proportion of each stock in this portfolio equals the market value of stock, divided by the sum of the market value of all stocks. The market portfolio is a portfolio consisting of securities, where the proportion invested in each security corresponds to its relative market value. Thus, the relative market value of a security is simply equal to the aggregate market value of the security divided by the sum of the aggregate market values of all securities. CAPM is built on the insight that the appropriate risk premium on an asset will be determined by its contribution to the risk of investor overall portfolios. All investors use the same input list. So, expected return beta relationship tells us the total expected rate of return is the sum of the risk-free rate plus a risk premium. If a stock is riskier than the market, it will have beta greater than 1. Let's move to arbitrage pricing theory. Generalizations of the security market line of the CAPM to gain richer insight into the risk-return relationship. The APT was developed primarily by Rose in 1976. It is a one-period model in which every investor believes that the stochastic properties of returns of capital assets are consistent with a factor structure. APT is a multi-factor asset pricing model based on the idea that an asset returns can be predicted using the linear relationship between the asset's expected return and a number of macroeconomic variables that capture systematic risk. Some of difference between CAPM are lambda in the APT does not have to be the market risk premium. In the CAPM, it must be. In the CAPM, beta is the scaled covariance of the asset return with the market portfolio. In APT, the beta is simply sensitivity to the factor. So, APT can be concluded as a multi-factor model for asset pricing which relates various macroeconomic risk variables to the pricing of financial assets. Finally, the implementation of APT involves 3 steps. First, we identify the factors. Second, estimate factor loadings of assets. And third, estimate factor premium. We have a quiz for this material. In CAPM theory, the relevant measure of risk and relevant risks are A. Beta as systematic risk, B. Unique risk as systematic risk, C. Standard deviation of returns as unsystematic risk, and D. Variance of returns as unsystematic risk. So, this is the end of this module. See you later.